Hello, students. Welcome to our second session of third module under investment analysis and management. In my first session, we discussed about what is fundamental analysis, and in EIC framework, we studied E and I. That is, we saw what is economic analysis and what is investment analysis. So under economic forecasting, we saw how to actually forecast the economy and what are the traits to be considered under economic forecasting, and we saw how industry analysis works and classification and its factors. Right. In our today's session, we'll discuss about company analysis. So what is company analysis? So first we studied about economy, then industry, and now we shall go to company, right? It is very micro in nature, wherein the particular stock or the particular share in which you want to invest, right? That has to be analyzed. For example, if I want to invest in Infosys shares, first I need to analyze economic analysis of India, and then I need to understand the information technology industry, or I mean the technology industry as a whole, right? How other companies or stocks are performing in the market, right? Then I need to analyze how Infosys is working, or what are the traits of Infosys stocks, right? So in company analysis, the growth of company is analyzed by the investor so that the present and future value of shares can be known, right? What is today's value and what would be tomorrow's value, right? One, we can at least estimate how it actually grows or how exactly it can vary, right? Next, the present and future value of shares is affected by following number of factors. There are various factors which would have an implication on the present value of the shares and future value. Future value in the sense it's not like compounding or anything like that. It is simply the price on a future date, right? It will be affected on various factors like competitive edge of the company or market share or growth of sales and stability of sales. We'll go in depth and study how to analyze this, right? First thing under company analysis is financial analysis. Financial analysis is like a key part of your company analysis. It involves analyzing the financial statements of the company, right? You take their balance sheet, you take their profit and loss account, you take their cash flow statement, and you exactly analyze what is their profitability, what is their dividend payout ratio, how are they performing actually, right? If you invest 100 rupees today in their shares, what is the amount of dividend you will get at year one, right? Also, there are various other factors you can understand when you go through balance sheet and P&L account, like what is their liquidity ratio, how well are they positioned in the market, what is their profitability rate. So all these things will can be analyzed with the help of financial analysis, right? Now going to the next part, analysis of financial statements. How exactly it works, you know there are various tools which you can use to analyze the financial statement. It helps the investor in determining the financial position and progress of the company. The various simple analyses that are performed to ascertain the financial position of the company are: first one, comparative financial statement. So these are the tools. Comparative financial statement is like your present year's values of the balance sheet will be compared to the previous year's value of the items in the balance sheet. For example, if you have buildings worth rupees 1 crore this year, what was it in the previous year? Was it 75 lakhs or is it 1.5 crores? And how exactly are they changing? Are they purchasing more fixed assets or are they selling more fixed assets? This you need to analyze, because Selling of more fixed assets is a key indicator that the company might go for liquidation in the near future. So these things have to be closely analyzed. You can do this analysis using comparative financial statement. Next, trend analysis. It shows the growth and decline of sale and profit over the years. Trend analysis is like you take up uh, some 5 years data and analyze how exactly is it moving. Is it having a particular trend, right? This will be analyzed using trend analysis. You take up particular, periods data, maybe last 5 years, what is their profitability growth, or what is their revenue generated. This we call it as trend analysis. Now next is common size income statement. Common size income statement actually shows the percentage of each item with respect to the net profit earned. So, so common size income statement actually shows each and every item in the income statement as a percentage to net sales. Net sales will be taken as the base figure, and each and every item will be, considered as a part. How much percentage is it contributing to net sales, right? Also, there is something called as common size balance sheet. Common size balance sheet is a tool which actually shows each and every item as a percentage to the total of the asset side or liabilities and in capital side, right? In case of income statement, it will be the base figure will be sales. In case of balance sheet, the base figure will be the totals of each side. Next is fund flow analysis and cash flow analysis. Fund flow analysis is a statement which shows the actual source and application of funds, right? What is the actual amount of funds flowing in and what is the actual amount of funds flowing out of the business. Cash flow analysis is like it is a statement that actually shows the cash inflows and cash outflows, right? One a few of the factors that you need to consider when analyzing cash flow statement is that there are few expenses that are non-cash in item. For example, depreciation. Depreciation will be shown in the income statement of the company, but actually the cash is not flowing out of the business, right? These things has to be considered when you are analyzing cash flow. Cash flow is like how well are you able to pay your short term debts, right? How are you managing your current assets and current liabilities? To analyze this, you need to understand cash flow of that particular company, right? Next is your ratio analysis. Ratio analysis is there are few technical ratios that are formulated which gives you accurate results as to what is the ratio of that particular thing you want to analyze. For example, if you want to analyze gross profit ratio has a formula, that is gross profit by net sales into 100. Now you can understand what is the actual profit contribution. You might say 10 crore revenue was earned during this particular year, but also you need to understand what is the actual revenue gained. You cannot just go by the figures like that. You need to understand what is my return. If I'm investing 100 rupees today, what is the return I'm gaining, right? So, if you have gained a net profit of 10 crores and your sales was 1000 crores, the profit contributed is 0.1%, which doesn't make much sense, right? So, you need to understand it with light of the base figures. That is the reason we need to calculate ratios. Also, it's not only about numericals here. There are various aspects of a company that you need to consider while analyzing the company, right? First is availability and cost of input. For example, when it comes to crude oil and other industries, it is very much probable that in the near future we are running short of the raw materials. The crude oil will get exhausted in near future, as a result of which the petroleum products will actually face a lot of issues. Your automobile industry, everything gets affected. When you want to invest in Indian Oil Corporation, you need to clearly understand till what time can the crude oil be available. So when will it run out? When will they likely close down? Or are they finding out any alternative solutions for these things? So cost and availability of input plays a major role. Next, order position. How well are they positioned in the market? What is their preference? For example, nowadays we can see a shift in customers' perspective towards petrol pumps. People tend to go more. They tend to visit Shell or SR petroleums more frequently than our Indian Oil Corporation or Bharat Petroleum, right? Because Shell and SR are basically private players who have entered into the market and they're providing very good customer service. So even Shell and SR sell petrol at higher rate. People tend to go and visit them frequently because of the service they give, right? So you need to understand how well the company is positioned in the market. Next is regulatory position. What are the regulatory considerations or constraints that the company is actually facing? All the companies cannot be left free, or they cannot be uh, you know perform freely. They have something called as regulatory constraints. So you need to understand how stringent is the law against how stringent is the law of that particular land, right? Next, technological and production capabilities. What is their technological capability? Use of more and more technology always have a better impact on the company. Always I use this example. If you consider Bajaj Chetak, which was ruling the market in late 60s and 70s and early 80s, even 80s, they were actually ruling the market, right? Compared to a Royal Enfield. But even today, you can see Royal Enfield in the streets pretty much. Actually, their sales have increased drastically, right? But you cannot see one Bajaj Chetak in your road, right? It's very hard and it's almost like extinct in the market. Why did that? Why did it actually happen? This is because Royal Enfield was constantly into research and development. They started analyzing what are the needs of my customers. Initially, they had ulta system wherein the gear was placed on the right hand side and brake was placed on the left hand side. They changed it, right? And then they recently, after 2000, a new model was introduced wherein right side brake and left side gear was placed so that it becomes convenient for the rider. After that, now recently they have they are they are very much intact with the BS6 version of your motorbikes. Also, they have left. They have started with ABS technology bikes, right? Anti-lock braking system, which is technologically very advanced, and people are actually appreciating it. While if you look at Bajaj's placement, Bajaj was forced to stop its production because they did not improve on research and development. They stick down to their traditional mindset. They did not want to change. The gear was placed on the hand, right? Gears was placed in the hand, which becomes very difficult for the riders. So if the company is very much into technological research and development, it is more probable that they can break through things and they can actually perform well in the market. So we need to understand how well is the company into research and development. Next is marketing and distribution. What are their marketing link, marketing distribution? What are their strategies? How well are they able to sell their products? Right? Finance and accounting. This we have seen. You need to understand what are their finance and accounting policies, and what are their constraints in obtaining loans or any such things. Also, what is their um, debt equity ratio and all those things needs to be covered. Next is human resources and personnel. Who all are there in the organization? What is their human resource requirement? Right, these things needs to be considered when you are analyzing the company, right? So now that we have completed EIC framework, we have completed fundamental analysis of a particular company. Now we'll get introduced to technical analysis. In this session, I'll brief you about what technical analysis is exactly into. So before starting that, technical analysis is so we studied fundamental analysis, which actually analyzes the entire economy, industry, as well as company, right? It has so many technical aspects. I mean, very in-depth knowledge of a particular stock. So if you want to purchase Reliance, as I told you, Reliance company stock, you need to analyze the economy first, and then you need to analyze the industry, and then you need to analyze the company. So technical analysis, on the other hand, goes by just the charts and other things which are there. I mean, which are available in the market. So technical analysis basically works on demand and supply of a particular script or share, right? So we'll see what are the assumptions of technical analysis. The market value of script is determined by the interaction of supply and demand, right? If supply increases, demand will decrease, right? They are inversely proportional to each other. The market discounts everything. All those things, there are no other considerations like your economy or your industry or anything like that. Market is the only thing which discounts everything. The market moves in trend. There is a trend which will be followed across the life of the script. If you see, all those variations will be in a cyclical manner. History repeats itself. This is what I was talking about. The market moves in a trend. That trend is repetitive in nature, right? There is one particular flow in which the trend actually works. If it increases or if it reaches the peak, that's the time you need to sell your share. If the script reaches the rock bottom, that's the time when you want to purchase. People do it other way around. So that's when they incur more losses. I don't know why this traditional mindset is there, right? It is true to the stock market also. Analysis of past market data can be used to predict the future behavior. You know, you can expect what would be the prices in near future, analyzing the previous year data or previous cycles data. So how did technical analysis actually, you know, come into picture? This is very interesting, topic. I want you people to actually analyze or go through the history behind this. This is very interesting. So there was one person called Dow Jones, right? Which, sorry, Charles H. Dow. So this person used to actually, he was an editor in one of the famous journal called Wall Street Journal. So Charles Dow and Nelson, there were two people who who were actually working with the Wall Street Journal. This journal was publishing data about several stocks and shares, and it's something like our Economic Times, right? But that was a journal, and this is a newspaper. So they started analyzing each and every stock closely. So they came to know that all the prices of stocks and shares will actually move in a particular uh, frequency, right? In a particular trend. So they started working as analysts using chart. They started plotting the prices of shares in a particular chart, and they observed that this chart is repetitive in nature. This whatever hikes and slopes are there, this was very much repetitive, right? They started analyzing various shares, and they actually started technical analysis, right? Now we'll see what is Doe theory. Doe developed this theory to explain the movement of indices of Dow Jones averages. The theory is based on certain hypotheses. The first hypothesis is that no single individual or buyer can influence the major trend of the market. If there is one paradigm shift in the market, if there is something going wrong, going up or going down in the share prices, it is not affected by only one person in the market. It is because of various news or rumors that spread across the market regarding that particular share of stock. The second hypothesis is that market discounts everything. We studied this. The third hypothesis is that theory is not infallible. The word infallible means this theory will not go wrong. This theory stands to be correct. That is the third hypothesis. So, Doe has actually divided the trend into three major parts. First is your primary trend, second is your intermediary trend, and third is your short term or minor trend. So what is primary trend? The security price trend may be either increasing or decreasing, right? The prices of the shares keeps on increasing and decreasing. It's not like constant type, right? So the primary trend is like major fluctuation, major hypes and lows for a longer period of time. It's not like short-term fluctuation. It's a primary trend refers to a long-term increase or long-term gradual decrease, right? If you look at MRF tires shares, it is actually trading at 60,000 or 65,000, which did not happen overnight. It gradually increased from 10 rupees or 5 rupees at IPO. Now it has reached 61,000 or 65,000, right? This happens over the time. This is an example for primary trend. So also we know that what is bull market and what is bear market. If there is an increasing trend, we call it as bull market, and if it is a decreasing trend, we call it as bear market. So I've explained what is bull market and how it actually works. Yes, one important thing is that so if you divide bull market into three clear-cut peaks, if you divide a bull market, each peak will be higher than the previous peak. For example, T1 is at a higher position than T1, T3 is higher position in a higher position than T2, right? The bottoms are also higher than previous bottom. So if it increases and decreases, again it increases. This increase will be higher than the previous increase, and again it will decrease. This decrease will be higher than the previous decrease. That is B2 is higher than B2. Sorry, B2 is higher than B1. B3 is will be higher than B2, right? Next, similarly, bear market, the market exhibits falling trend. The peaks are lower than the previous peaks. The bottoms are also lower than the previous bottoms. So now, what is secondary trend? Secondary trend is of a short-term nature when compared to primary trend. The secondary trend or the intermediate trend moves against the main trend and leads to correction. If it is moving continuously up and down, up and down, up and down in primary trend, the secondary trend moves, against the main trend so that the things are balanced. That is the reason the secondary trend actually works. The correction would be 33% to 66% of the earlier fall or increase. Compared to a time taken for primary trend, secondary trend is swift and quicker. This I told you. It actually has a lesser time span. So if the primary trend is increasing at a higher pace or a normal pace, secondary trend will tend to decrease for the time being, right? So that the balance is strike between both the trends. Next is minor trends. Minor trends are like daily price fluctuations. Every day we'll be seeing price fluctuations in the prices of stocks and shares. So this minor trend tries to correct the secondary trend movement, right? If secondary trend we have seen, if it would be decreasing. So minor trend moves against this secondary trend movement to have a balance between all the three. So tools and technical analysis we'll see in our next session, right? Thank you.